We are talking about financial accounting. And I know a couple of you guys actually mentioned managerial accounting. Managerial accounting comes next. And that is everything for the internal user. We are talking about the wonderful external user in this class. So everything we're doing in this class deals with that outside person, all creditors and investors. So people that are going to be using our financial statements. So the big thing that we need to know in this chapter is working with the 4 financial statements. All right, now, the basic accounting equation sitting right here in front of us, talking about assets equal liabilities plus stockholders' equity. And when we talk about an asset now in chapter 2, we talk a lot more about it, but an asset are resources that are owned by a company. And one way to keep that in mind is thinking about what do you have, personally. So when you think about things that are owned, we think we have cars, houses, furniture. Those are all things that we own that are big items, okay? Those actually are going to be ended up calling property, plant, and equipment. Businesses have vehicles, they have buildings, and they have equipment. That's what these end up being. PP&E, property, plant, and equipment. Then we have cash. Cash is owned by us. We have supplies. Those are all assets. Liabilities are things that are owed to people. All right? Those are typically going to be our accounts payable and our notes payable. And we'll focus on that for right now. And then on stockholders' equity are those that are owed to the shareholders or stockholders. Okay, and that's the company's wealth. So for us, if we're looking at it as us, accounts payable, notes payable, that's our bills. And our wealth, for us, that's like our 401k. So we can put ourselves in this basic accounting equation as well, just like a business can. All right, assets equal our liabilities plus stockholders' equity. And if you look at it, everything we own personally is going to be based on what we are able to buy with our wealth plus any loans we have is what and how we own all of our assets. So assets equal our liabilities plus our stockholders' equity.
Wait a minute, hold on.
I'm going, all right. You got a question there?
Yeah, can you go back to that real quick?
Back to that picture? Yep.
Sorry.
Nope, that's all right. I just had to hit the right button.
Slow rider.
Nope, that's all right. You definitely have to yell at me. All right, then the next couple of slides just go over some things or what typically are assets. And these are important slides to go back and look, whether you're looking in your book or you come back and look at the slides. Remember, things that you own. So a good way to keep this in mind, especially if you didn't have applied accounting, or what things do I own? What would be considered an asset to me? If it's an asset to you, it's going to be an asset to a business. Accounts payable, as I mentioned before, those are going to be right now notes payable and accounts payable. The difference between the two is a notes payable is almost always going to be long term, and it's going to be a formal agreement, meaning that interest is going to start right away. And accounts payable is going to be something like our cell phone bill. You're given 30 days before interest starts. Our electric bill, you're given 30 days to pay it before your interest starts. And then there's our stockholders' equity. There are two main stockholders' equity that we'll focus on: common stock and retained earnings. And retained earnings is the equity earned by the company That's our net income we'll talk about in a minute. And common stock is the equity paid, which is when people buy stock in our company.
Hey team, may I use my respectful courage and ask everyone to mute their phone if you're not asking a question?
Yes.
There's a lot of background.
Okay, yes. Yes, if you could do that. And then if you do have a question, make sure you unmute it. Thank you very much. Okay, so we have 4 financial statements. The first one is the income statement. All right. It's easy statement from the standpoint you have 2 things. You have revenue minus expenses. All right. This is how we live. We have our salaries coming in and our expenses going out the door. All right. Revenue is the money we make doing what we do. So for a business, if you're a restaurant, your revenue is your sales from the restaurant, and the expenses is the cost of the restaurant. It would not be the fact that you started getting that you once or twice sold an oven. That's not part of your revenue stream. That would be an additional sale. A better example would be the college revenue stream is tuition. And then obviously we have the revenue stream from the bookstore and the cafeteria. But we're not in the business of selling buildings, even though the college just recently sold where the administration used to be downtown. So even though we sold that building, the revenue stream would not go under revenues here. It would be shown on an expanded income statement as other income, which we'll get into much later in the semester, but it would not be revenue. And the expenses that go along with that would not be expenses because that would not be an everyday expense. When investors see your net income, they want to see how much money are you making doing whatever it is you do. All right? So that's our first statement. And second statement we would then do is our statement of retained earnings, right, which is coming in down here. And we're also going to talk about dividends. All right, dividends are a return to investors, and they go on the statement of retained earnings. All right, so we are going to do the income statement, which is followed by the statement of retained earnings, which is followed by the balance sheet, which is followed by the statement of cash flows. And there's a reason for that, and that's because each one of them has something that the other one needs. And actually, the last 2 could be done at the same time, because the income statement produces net income, and net income goes on the statement of retained earnings. And the statement of retained earnings gives us ending retained earnings, which goes on the balance sheet. The balance sheet has cash on it, and the statement of retained earnings has ending cash, the statement of cash flows has ending cash, and those 2 numbers just need to equal. So that's why the statements are prepared in that typical order. Income statement, statement of retained earnings, balance sheet, statement of cash flows. Chapter 2 is all about the balance sheet. Chapter 3 is all about the income statement. Chapter 12 is all about the statement of cash flows, and the statement of retained earnings doesn't get its own chapter because it's so small. All right, this is what the income statement looks like. What we had just talked about. Notice we have all of our revenues listed first. Then we total it. It is for a month because we don't say we got this much revenue on one day. We got revenue over a whole period. We list out all of our expenses. We total them to come up with our net income. All right, now, this $2,000 is going to go on our next statement, which is the statement of cash flow. Statement of retained earnings. Now I'm getting them out of order. So see here, we have net income, $2,000. So we have beginning retained earnings, which is 0 because this company just started up. So if you're just starting up, you cannot have any money because you didn't have any to begin with. So your beginning retained earnings is 0. You add net income, you subtract dividends, you have your ending retained earnings. It's also for a month because you're looking at it over a period of time, beginning and ending. Then you take this ending retained earnings and it goes on to the balance sheet. Now you can only give dividends if you have money in retained earnings. You cannot give a dividend if you don't have cash to do so. All right, and then this is the balance sheet. This is a simple balance sheet, but look down here. That's our ending retained earnings. We list all of our assets first. Then we list our assets here, total $36,000. Then we list our liabilities, our stockholders' equity, and then those should total our assets because our assets equal liabilities plus stockholders' equity. Notice the balance sheet is not for a month. I'll turn my pen off. It is for 1 day. And that's because you have a lot of things on the balance sheet that change on a regular basis. It's not like revenue that you're accumulating over time. Cash changes every day. Accounts receivable is when someone owes you money and they could be paying you and they could not be paying you. Supplies could be going up and down, accounts payable. So those numbers change. So a balance sheet is a snapshot in time. And then let's look at our last one. Now remember, cash was $13,000. And here is our statement of cash flows. There's our ending cash. There's our $13,000. And statement of cash flows is divided up, and we will talk a lot more about this, but it is divided up into what we call operating activities, investing activities, and financing activities. 3 different activities in a business, but it does not go on the statement of cash flows unless you actually spent cash on it. It is also for a period of time. All right, so operating activities are day-to-day type activities. Investing or when you buy things like property, plant, and equipment. And financing is usually stocks, loans, and dividends. Blank. Okay,